Okay, let's dive into something that sounds complex but is absolutely crucial for understanding the global economy.
I mean, think about it for a second. Why on earth would a country give up control over its own money? It sounds kind of crazy, right? But this one question, it's the key to understanding why so many countries decide to anchor their currency to someone else's, even though it means giving up a huge chunk of their own economic power.
So here's how we're going to tackle this. We've got 5 parts. We'll start with the problem itself. What are currency pegs even trying to fix? Then we'll get into how they work, the different types, a huge dilemma they create, and finally, what happens when it all goes wrong. All right, first up, the problem of floating money. Just imagine for a moment a world with no anchors, where the value of your money could change wildly from one day to the next. That's the chaos we're talking about.
Think about it like this. Let's say you're running a business. You sell a bunch of stuff to a customer overseas. You agree on a price, but by the time you actually get paid, the exchange rate has totally tanked. Suddenly, that payment is worth way less, maybe 20% less. Your profit? Poof, gone. That's the kind of massive risk that pegs are designed to get rid of.
Okay, so if that's the problem, what's the solution? How do countries actually create this stability? Let's get into the mechanics of how these pegs actually work.
At its heart, the idea is pretty straightforward. You just tie or peg your currency's value to a big, stable currency like the US dollar. The goal is to create predictability, so businesses and investors know what to expect.
But here's the thing, and this is super important to understand. A peg is not a set-it-and-forget-it kind of deal. Not at all. It's more like a constant, active job for a country's central bank. They have to be ready to defend that peg 24/7.
So let's say your country's economy is booming, and investors all over the world want to buy your currency. That demand could push its value way above the peg. So what does the central bank do? They jump in and start selling their own currency to bring the value back down. They're basically increasing the supply to meet the demand.
And of course, it works the other way too. If investors get spooked and start selling off your currency, its value can start to sink. Well, the central bank steps in again, but this time they do the opposite. They start buying their own currency using their reserves of foreign cash, like US dollars, to push the value right back up.
Now, it's really important to know that not all pegs are the same. You can think of them as being on a spectrum. On one end, you have these super rigid, ironclad rules, and on the other, you have much more flexible setups.
Yeah, so on one side, you've got what are called hard pegs. A great example is a currency board, where the commitment is just absolute. Every single local dollar is backed by a foreign one. But on the other side, you have soft pegs. These are more relaxed. The currency can kind of float around within a set band, which gives the central bank a little more wiggle room.
And this table here, it lays out the trade-offs perfectly. Just look at the hard peg row. See that? You get really high stability, which is awesome. But what's the cost? You have absolutely no control over your own monetary policy. It's a classic give and take. The more stability you want, the more economic control you have to sacrifice.
Probably the most famous example of a massive peg system was Bretton Woods, right after World War II. Basically, almost the entire world agreed to peg their currencies to the US dollar, and the dollar itself was pegged to gold. And for about 25 years, it worked. It led to this amazing period of stability and growth, that is, until the whole thing came crashing down in 1971.
Which brings us to the fundamental problem with currency pegs. It's this huge, unavoidable conflict. A really tough choice that every single country has to make if they're even thinking about going down this road.
Economists call it the impossible Trinity. It's like a fundamental law of international finance. And what it says is that a country is basically forced to make a choice between 3 very desirable things.
Okay, so what are these 3 things? Well, first, you want a stable exchange rate. That's a no-brainer. Second, you want capital to be able to move freely across your borders. And third, you want control over your own monetary policy, the ability to set your own interest rates to speed up or slow down your economy. Sounds great, right? Well, here's the catch. You can only have 2 of the 3. That's it. So by choosing a fixed exchange rate, by choosing the peg, a country has to give something up, and almost always what they give up is their independent monetary policy. They lose the power to, say, cut interest rates to fight off a recession because doing that could break the peg.
So what happens when this incredibly difficult balancing act finally fails? What happens when the anchor breaks? Well, let's look at a real-world example, because when this goes wrong, it can go catastrophically wrong.
Let's talk about Argentina. Back in the early 90s, they were dealing with insane hyperinflation, so they went all in on a hard peg to the US dollar, and for a while it worked like a charm. But then, in the late 90s, the US dollar started getting really strong, and because Argentina was pegged to it, their currency got dragged up too. Suddenly, their exports were way too expensive for anyone to buy, and the country fell into a deep, deep recession.
And when I say they went all in, I mean it. They set up a currency board with a strict 1-to-1 peg. 1 Argentine peso for 1 US dollar. That meant for every single peso out there, there was supposed to be a real US dollar sitting in a vault at the central bank.
And this is where you see the true cost of that impossible trinity. Because Argentina had given up its own monetary policy, its government was completely powerless. They couldn't cut interest rates, they couldn't devalue the peso to make their exports cheaper. They were trapped, and the result was just a total economic and social crisis.
But look, this isn't just some dusty old history lesson. The exact same challenge, the same fundamental dynamic, is playing out right now in the crypto world with stablecoins. I mean, think about it. Stablecoins are basically just private, digital versions of what Argentina tried to do.
And they face the exact same risk. A stablecoin that's supposed to be worth 1 US dollar needs to have 1 real US dollar in a bank account somewhere to back it up. If people start to doubt whether those reserves are actually there, you get a run on the stablecoin, and that peg can shatter in a matter of hours.
So it really leaves you with this big question, right? We're building this whole new digital financial system with all this incredible new technology, but have we actually learned the lessons from the past? Because the tech might be new, but those impossible choices, those fundamental economic rules, they haven't changed at all. The search for stability always comes with a cost.